There's a number in personal finance that almost nobody talks about, honestly. It's not $1 million, it's not six figures, it's not even 50,000. It's $20,000. And the reason nobody talks about it is because it reveals something uncomfortable about how the system actually works. If you've never had $20,000 sitting in an account, you're playing a fundamentally different economic game than someone who has. Different rules, different opportunities, different math. This isn't about becoming rich. 20 grand doesn't make you wealthy. It won't retire you. It won't buy you a house in most cities. But it does something else entirely. It flips a switch. It opens a door that was previously invisible. And most importantly, it starts a compounding effect that people without it can barely access. The strange part? This isn't a secret. Banks know it. Financial institutions are built around it. The entire investing industry depends on it. But if you're on the wrong side of that threshold, the system has very little interest in telling you how it works. Let's talk about why everything changes after $20,000 and why that number keeps getting harder to reach. Here's what makes $20,000 different from $2,000 or $10,000. It's not just more money, it's the minimum amount of capital where money stops being purely defensive and starts becoming generative. Below $20,000, every dollar you save is essentially insurance, a buffer against disaster. You're not building wealth, you're building a wall between you and catastrophe. That wall is important, but it's not the same thing as growth. At $20,000, something shifts. You have enough to still weather emergencies and start deploying capital in ways that generate returns. You're playing both defense and offense simultaneously. Why this specific number? First, it's roughly where compound interest stops being theoretical and becomes tactile. At 5% annual return, $20,000 generates $1,000 a year passively. That's not life-changing, but it's real. It's 2 weeks of groceries. It's a surprise expense you don't have to stress about. It's the beginning of money making more money. Second, it's where access begins. Not access to wealth, access to the tools that create wealth. Minimum investment thresholds, better lending terms, the ability to take risks without risking survival. Third, and this is the part that matters most, it's where the poverty tax starts to fade. You know what the poverty tax is, even if you've never heard the term. It's the extra cost of being broke. Overdraft fees, check cashing fees, buying the cheap shoes that fall apart in 6 months instead of the expensive ones that last 3 years, paying rent forever instead of building equity, missing bulk discounts because you can't afford to stock up. $20,000 is roughly where you stop paying that tax, not completely, but enough that your money starts working with you instead of bleeding out through 1,000 small wounds. Let me show you how the math actually works in practice. Take 2 people. Both earn $60,000 a year, same city, same cost of living, same expenses. Person A has $3,000 saved. Person B has $23,000. An emergency hits, let's say a medical bill, $2,000. Person A has to make a choice. Drain most of the savings and live exposed to the next crisis, or put it on a credit card at 22% interest. Neither option is good. They choose the card because they can't risk going back to zero. Over the next year, that $2,000 bill costs them about $2,400 with interest. Person B pays cash. Annoying, yes, but their safety net is intact. They're still earning interest on the remaining $21,000. The bill cost them exactly $2,000. Same income, same emergency, $400 difference in actual cost. Now multiply that across every financial decision for 5 years. Car repairs, job loss, family emergency, opportunity to change careers, side business idea. Person A is constantly in recovery mode. Person B is accumulating. The gap doesn't stay $400, it compounds into tens of thousands. But here's where it gets truly weird. $20,000 changes how other people treat you. Banks offer you better rates when you have reserves, not because they're charitable, because risk calculations shift. You become a different class of customer. Landlords accept your application easier. You can negotiate prices because you're a cash buyer. You qualify for credit cards with rewards instead of fees. You can take the lower-paying job with better long-term prospects because you have runway. These aren't marginal advantages, they're structural, and they all require crossing that invisible threshold where you're no longer in pure survival mode. Let's talk about what happens in the investment world, because this is where the gap becomes exponential. Below $20,000, investing is mostly performative. You can open a brokerage account with $100, sure, but the returns are so small they're almost insulting. $10 grows to $11 in a year. Congratulations, you earned less than an hour of minimum wage work. At $20,000, investing becomes meaningful. That same 10% return is $2,000. That's real money. That's a used car. That's a semester of community college. That's seed capital for a business idea. And here's the acceleration point. Once you have $20,000 growing at 10%, you're gaining $2,000 a year without doing anything. The person still trying to reach $20,000 by saving 5% of their income is putting away $3,000 a year from a $60,000 salary. But they're starting from zero, so year one, they have $3,000, you have $22,000. Year two, they have $6,000, you have $24,000 plus another $2,000 in returns, you're at $26,000. Year 5, they're at $15,000, you're at $32,000 plus $10,000 in compound growth, you're at $42,000. Same savings rate after that initial $20,000, but the trajectory is completely different. They're climbing a hill, you're riding a rocket. This is what people mean when they say the first $100,000 is brutal. It's not hyperbole, it's just math. Wealth accumulation isn't linear, it's exponential once you have enough capital to deploy.
Now, let's zoom out and look at what's happening in the broader economy, because something strange has occurred over the last 40 years. $20,000 used to be achievable for a median American household within a reasonable time frame. In 1985, median household income was about $27,000. Hitting $20,000 in savings meant banking roughly 9 months of gross income. Hard, but possible. Today, median household income is about $75,000, so $20,000 should be easier, right? It's only about 4 months of gross income now. Except, nobody can save 4 months of gross income anymore, because the cost structure of life has fundamentally changed. In 1985, housing plus transportation consumed about 35% of median household income. Today, it's over 50%. Add healthcare and childcare, and you've eaten 70 to 80% of gross income before you've bought food. So that easy $20,000 now takes the average household 8 to 12 years to accumulate, if they're lucky, if nothing breaks, if nobody loses a job, if there are no medical emergencies. Which means fewer people are crossing the threshold, and the ones who do are crossing it later in life, which means less time for compound growth to work. This isn't accidental. An economy built on consumption needs people spending, not saving. It needs people living month to month, not accumulating capital. Because capital creates independence, and independence reduces consumption. Here's where the online financial advice becomes almost grotesque. You've seen it, the content, the gurus, the influencers. Just skip the daily latte, cut out streaming services, meal prep, and stop eating out. As if the person making $40,000 a year in an expensive city just needs a better budget spreadsheet to magically save $20,000. Let's run the actual math. Someone earning $45,000 in a mid-sized city. After taxes, they're taking home maybe $34,000. Rent for a modest one-bedroom, $1,400 a month. That's $16,800 annually. They're down to $17,000 for everything else: food, transportation, insurance, utilities, phone, internet, basic clothing, unexpected expenses. Let's be wildly optimistic and say they can cover all of that for $12,000 a year. That leaves $5,000 for savings. At that rate, reaching 20,000 takes 4 years. That's assuming perfect execution, zero medical emergencies, zero car repairs, zero job loss, zero life happening. And here's the part that makes this advice offensive. It ignores the precarity tax. When you're that close to the edge, you can't optimize for the long term. You have to optimize for not falling off the cliff tomorrow. You take the job that pays more now, even if it has no growth, because you need rent money next month. You pay for the expensive emergency repair instead of the cheap preventative maintenance because you don't have cash for the latter. You miss bulk discounts. You pay more for worse financial products. This isn't financial illiteracy, it's rational decision-making under constraint. The people telling you to just discipline your way to 20,000 usually started with help. Family safety net, no student debt, a gift, a cushion that let them take risks without catastrophic consequences. And that's fine. Advantages exist, but pretending they don't, pretending it's purely about discipline, that's where it becomes dishonest. So what happens at scale when fewer people can cross this threshold? You get second-order effects we're already seeing. First, the middle class disappears because the middle class was never really about income. It was about security, about having enough capital to withstand shocks, to make long-term decisions, to invest in education and opportunity. $20,000 isn't middle class by historical standards, but it's the minimum threshold to stop living in constant financial fear. When that becomes unreachable for a growing percentage of people, you don't get a society of strivers moving up together. You get bifurcation, a smaller group with capital and compounding growth, a larger group trapped in liquidity cycles where every dollar earned must be immediately spent. Second, risk-taking collapses. Entrepreneurship requires cushion. Changing careers requires runway. Going back to school requires the ability to not work. All of that depends on reserves. When people can't accumulate reserves, innovation slows, not because ideas disappear, but because the capital to pursue them doesn't exist. Third, and this should concern everyone, social mobility freezes. The story we tell about America is hard work leads to prosperity, that anyone can climb the ladder. But if the first rung requires $20,000 most people can't accumulate, the ladder isn't functional, it's decorative. And that's where things destabilize. People can tolerate inequality if they believe the system is fair, that their effort matters. But when the math becomes transparently rigged, when crossing that threshold feels more like winning a lottery than an outcome of discipline, faith in the system erodes. Let me show you what happens after you cross the line, because this is where it gets uncomfortable. It gets easier. That 20,000 becomes 30, then 50, then 100. Not overnight, but the trajectory changes. You're no longer fighting entropy, you're riding momentum. At 50,000, you can take strategic risks. You can invest in opportunities with higher variance. You can wait out a job search for the right role instead of taking the first offer. At 100,000, you're thinking about real estate, about retirement that might actually work, about generational wealth. And here's the full architecture of the system. Every threshold you cross makes the next one easier. The person with 100,000 can afford to lose 10,000 on a risky investment. The person with 2,000 cannot. So the person with 100,000 has access to higher risk, higher reward opportunities that accelerate growth. Same intelligence, same work ethic, completely different games. This is why wealth concentrates, not because rich people are smarter or work harder, but because capital itself generates opportunities that require capital to access. It's a loop, and the entry point to that loop is somewhere around $20,000. So where does this leave us? Here's what we know for certain. $20,000 is a threshold that fundamentally changes your relationship with money. It's where compound interest becomes real, where access begins, where the poverty tax starts to fade, where you can finally play offense instead of only defense. And we also know it's getting harder to reach, not because people are less disciplined, but because the cost of existing has inflated faster than wages. The math is just uglier now. And we know what happens when fewer people can cross that threshold. The middle class hollows out, risk-taking declines, social mobility stalls, the economy bifurcates into those with capital and those without. But here's the question nobody really wants to answer. Is this a bug or a feature? Is the difficulty of reaching 20,000 an unfortunate outcome of market forces and policy choices? Or is it structurally necessary for an economic system that requires constant consumption and a steady supply of labor with no other options? Because if it's the former, we could fix it. Better wages, lower costs, policy interventions that make saving possible. But if it's the latter, if the system actually depends on most people never accumulating that initial capital, then we're not talking about financial advice anymore. We're talking about something much harder to fix. And that's the real reason nobody talks about the $20,000 threshold, honestly. Because once you see it, you can't unsee what it reveals about who the system is designed to serve.